The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good afternoon, folks. This is Larry Pesavento for the afternoon show for TFNN. If you have any questions, it's 877-927-6648. And as most of you know, we had a pretty big announcement coming out of Spain in the middle of the night last night here. Of course, it was early morning over there, where they gave him 100 and X whatever $billion it was, and the market, had a huge gap up and has given, most of it. In fact, it's given all of it back. It's back below where it was, on Friday. We're going to have to expect more of these types of things because we're in this really tight band of where we're going to increase volatility a great deal. This started way back on May the 20th, and it extends all the way through June. And then, of course, in June, we could be getting ready for a bounce. And my assumption is that we're going to come down into the somewhere between the 17th and 20th of June, and then we'll see if we can make a bottom there, and then we should have about a 5 or 6 week relief rally if it follows the Bradley model, the way we think it's going to happen. But this is something that we will know as we get closer to that date. Now, for Tiger TV today, what I did was I posted the chart for the euro. And if you'll take a look at euro on the hourly chart, you'll see that when it gapped up today, it stopped at the exact AB equals CD 1.27 pattern at that 126.70 level. It actually stayed there for about 20 minutes, and then it started to work its way down, and it's now dropped well over 170 pips in a matter of just a few hours. And this tells us that the market is still under a great deal of pressure. Folks, we're in a credit market bubble here. I don't think there's any. This is my opinion, of course. I shouldn't be so dramatic. I have to get off my soapbox here, but we're in a credit. We're in a credit bubble is where we are. Before this is all over, it might take a year. It might take 3 or 4 years. But, you're going to see interest rates a lot higher, and you're going to see some of these bonds that are junk bonds are actually going to be junk, and, we'll know more about that as we go along. But as far as I can see, looking at all these charts and all these patterns, we are definitely near the end of this bubble, and that's going to be the big move like it was from 1981 to 2012. I think the next 10 years or so, you will see, more normal markets as far as interest rates, where the banks actually, will pay you 2 or 3% for your money as opposed to 0 or actually negative rates like they have in Germany. So the things I wanted to really bring out today, when we have news items like this that come out of Europe, keep an eye on the euro because that's the largest currency in the world versus the dollar. Nothing equals its volume, nothing equals its liquidity, and it follows the number patterns and things that we look at, extremely well. And, what all it did was it went up and took out the high of last Thursday by, 1.27 expansion, and then has since, given it back up. Now, the S&P, gapped up, quite a bit, but, that's just a really a fraction of the market that the euro is, folks. I mean, it really is. When I first started trading the S&P back in April of 1982, when I was down on the floor, the currencies were the bigger markets. The currencies, and of course, they had Treasury bills, and the gold market was far, far bigger than the S&P. There might only been 5 or 6 people in the S&P pit because the S&P was trading at about 104, I believe, is what it was trading for, and it was trading at a discount to cash. So there was nobody in it, and everybody referred to the pit as the stop and pee pit because there was no liquidity and no volume in it. It took a long time, well through the summer of 1982, after the bottom was made on August the 9th of 1982. It wasn't until the fall that the market finally started to turn to turn up, and that's when President Reagan, who was elected in 1980, gave his speech where they were going to let the bulls loose, and that is in fact what they did. And then the market went, all the way up into the 1600s, after that level. But at that time, it was, just not being traded at all. So you can't really gauge what the market's doing by what the S&P is doing. But if you'll pay attention to what's happening to the euro, that's real money, really moving, and there's no ifs, ands, or buts about it. There's nothing comes close to the liquidity and the volume that you have with the euro versus the S&P or anything else. The bonds were okay, but they're just even a fraction of what you have with Forex and the euro versus the dollar. You have really good volume in the pound, which is also important. And if you'll take a look when you get a chance at the pound chart, you'll see that it's held the 152 level 3 times now over the past several months. So as long as the pound can stay above the 152 level, it's going to be really interesting. Now, the U.S. dollar, we had that big AB equals CD pattern up there at the 83 and change level, and we got down to 82 today in the middle of this big collapse that we had in the euro. But in fact, that we've given it all back, and that makes you believe that we're probably, this U.S. dollar, if it can hold this level of where we are now, we've been down for 5 days, and we really didn't go very far, to the downside. And so this is where I think if we start to look at this on a little bit shorter time frame, we might be getting ready, to break out to the upside on the U.S. dollar, and that means if we get above the 84 level. There's really not much as far as support that will keep you from going any higher than that, because there's so much there, a resistance at the 84 level. If we clear that after a really small correction like we're having now, we've been down 5 days, didn't really go very far. We got down to the 81.90, and we were looking for it to go to 80.50, which we certainly could still make it. But right now, the way that's acting, given all the news, my assumption is that it's not probably going to make that level as easy as some people think that they could. But the dollar does look, incredibly strong, given all the other currencies in the world, and at least from this level, the dollar yen still looking pretty good. We were looking to buy that, a few weeks ago down in the the 78 level, and that's held up extremely well. And we definitely want to watch that. Now, as far as the stock market is concerned, when I look at different indices, when I'm just watching the Dow, and I watch the S&P, and I watch the Nasdaq, and I watch the transportations, and we have a huge divergence here because the Dow Jones Utility Index has gone into new high ground by quite a bit, as a matter of fact, but all the other indices, are still in downtrends. We've had lower highs. And actually on this last little run here, with all the news and everything, the Dow Jones Transportation Index actually did not even make up take out the highs of the previous day, which also can be a, relatively, negative thing if you're looking at it on a shorter term basis. Now, the next part of this little dissertation that I'm giving you now is my opinion, okay? And this is what it is. It's my opinion. Looking at the cycles, we had a major low on May the 20th on the solar eclipse new moon. We rallied up for 5 days. We came down hard into the new moon, the full moon and the lunar eclipse of June the 4th. And I expected that P-index date on the 6th to be a pretty good low. Well, it didn't make a lower low than the 4th, and frankly, I don't know if the date came in the 6th or whether it failed or not, or it was 1 day early. I really don't know. All I know is that something happened on the 6th, because that was the strongest up day we've had this year in this market, with the Dow up 300 points. So we need to watch that date very closely. Ideally, what I would like to see is that if you would take a look at the if we get another low coming in on the 17th or the 18th, that will be I believe it'll be on next Tuesday or Wednesday, I believe. And that's what I would be watching for as far. No, see, that'd be 11 and 7. But that would be the 18th. It'd be Monday or Tuesday, 18th or 19th. If we could come down into that date one more time, or maybe a sharp jab, and maybe even really bad day down or something like that, that's where I think we could probably get a tradable bottom off of that level. And then if the Bradley model is correct, we should have a 5 to 6 week period where we're going to be going up to sideways, and then after, I believe, the end of July to the 1st of August, that's when we really will start the next leg of this what I think is a major bear market to the downside. This might also be the leg that allows us to get into the bond market one more time, and we'll certainly be able to get. They'll always let us in. The question is if they'll let us in at the price that we want to let us in at. So these are the things that we're looking for. Someone asked me to take a look at the price of Apple, and Apple made that big AB equals CD move way down at the 530 per share level, and it's rallied over $50, which is about 15% over the past several weeks, I believe, and now we're getting up into a little bit of resistance up in the 585 level, which is the 61% retracement of that previous move that we had before. I will try to, as a matter of fact, I will do it right now before the break. I will put the chart of Apple into the room here into Tiger TV, so you guys will take a look at this thing, because it's been a really nice move as far as the ABCD down, and then we've had a tremendous rally here, and it's been the best stock to buy pretty much all along. And we're looking at it now to get up into this possible the 596 level, which would be another Gartley pattern. It has been by far, the fact is, the last bottom that we made just on the full moon day was an exact 61% retracement down at that 548 per share level. That was exactly 61% of the move from the 17th of May up into the 30th of May, and then down into the new moon and lunar eclipse of June 4th. That low that morning was at 548.72, which was a perfect 61% retracement on Apple at that point. Now, this is why I love the Fibonacci numbers and these ratios so much, is because when they hit, sometimes they hit absolutely perfectly. And an example that we talked about this morning was the euro, and it stopped exactly at the point that it was supposed to be. Now, the S&P, if you'd been looking at that on the same type of expansion, that measured to 1338.5, and I believe a high overnight was something like 1339.75 or something like that. So these numbers are pretty good, and what it does is it just tries to get to a point where you're able to,
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
Stock market corrections are the number one reason that a buy and hold investment strategy produces the poorest results, and I have 73 years of data that proves it. Now, the good thing about economic difficult times is that the worst economy can produce the best rewards in the shortest period of time. In fact, during the last 130 years, 61% of that time period has been spent in recession. And if you're one of the 70% of American households relying on their 401ks and IRAs for retirement, you need the single strategy that is bulletproof against the turmoil of our stock markets. Go to the homepage at TFNN.com. Under Breaking News, click on Success is a Numbers Game to receive this must-have free report. This bulletproof strategy may be days away from giving the next signal. Don't neglect your retirement, and don't neglect this signal. If you're even a little bit interested in accumulating wealth, providing a better life for you and your family, then go to TFNN.com to order your free copy of Success is a Numbers Game today. Implement the disciplines contained in this report, and success will be yours for the taking.
Kate Stalter's exciting newsletter, Low Priced Leaders, has just launched, and now is a great time to get a 2-week free trial. Every Wednesday afternoon, Kate sends out her weekly newsletter to her subscribers where she focuses on small cap stocks with market caps under $2 billion, as well as low-priced equities with share prices ranging from $5 to $12. Kate tracks a variety of stocks with a combination of strong technical support and solid fundamentals. Many of the stocks featured will be recent IPOs. These newer issues are often some of the biggest price gainers in the market and provide an excellent opportunity for substantial gains if timed correctly. You can catch Kate Stalter live on Tiger TV with her Small Cap Roundup every Tuesday and Thursday at 11 a.m. Eastern Time, and visit TFNN.com right now to get your 2-week free trial to her brand new newsletter, Low Priced Leaders, while locking in the low introductory monthly rate of only $37.50 per month, almost a 50% discount. Act now.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
We're back, folks, and I'm going to put in the Bradley model. I'm going to extend it out a little bit so we can look at it on a little sort of a microscopic environment, so we can just look over the last 6 or 7 months. But as you can see, if you get a chance to go into Tiger TV, you'll see that there is a low coming in next week, about Monday or Tuesday, 18th to 19th. There's a pretty good astro date coming in there, and then until about the 13th, looks like about 7 weeks there, we have a pretty good chance of a rally, and then after that, we're down for well over a year, if in fact it continues to follow. Now, we'll know more, as we get into next week, but it would not be unusual for the market to come down and take out the low one more time and get down to maybe even as low as 1,000 points lower in the Dow from where we are right now. That would be down around 11,533. That's what that APCD would measure to, and that's also the 61% retracement coming off of the low from last October, which was our last major really bullish Gartley, and where the market turned up from, using the Bradley model. And the Bradley model is far from perfect, folks. It's a model based on the power of cycles, whether they're positive or negative, and what it's saying is from the time from around the June 18th, 19th into August, early August, that the negative cycles that are there have dissipated a little bit. That doesn't mean we're going to go straight up, it doesn't mean we're going to go straight down. It's just a theory. And that what we're trying to do is to match the theory, with the patterns that we're looking at. Because the patterns are what determines whether you can make, a buck at this. And that's really what you're doing. You've got to be really pragmatic about using the Bradley model. If you can make money out of it, that's great. If you can't, use something else. That's what I think. And, I use it a lot, but when it's not working, I always rely on the patterns because those are the ones that'll get you to the promised land. And that's one of the reasons why I'm so bearish the bonds, on a long-term basis is because of the fact that we have this, big butterfly that is formed on the monthly chart, going back to 1981, and that is, really a pretty bad sign. Now, in the I happen to be a friend of Bob Prechter, who writes the Elliott Wave Theorist, and he posted he has some really good long-term data and some long-term charts that he looks at. And one of the things that I happened to look at this month was the chart for the I've lost my train of thought, for the long-term bonds based on the reverse. In other words, what the price of the interest rates were, instead of the price of the bonds going up, the interest rates would be, going to the upside. And I have a reverse of that, and the problem is that I'm having a technical difficulty getting the darn thing to come up, and so I'm not going to be able to post that. Maybe after the break here, I will figure out, what's going on with it, and we'll be able to get it to work. But right now, I'm not able to do it. I put that chart into the newsletter this week, so that you folks that do to get the newsletter, you can get a picture of what it looks like. It looks just like the bond chart, only it's reversed, and it gives you an idea that the market has been going up into a what we think is a major top, and from that level, that's what we're really trying to see is that we're going to get a spot here where we don't have any more really lower term interest rates, because what's going to happen is that these prices are not going to stay at these levels for very, very long. I'm almost 100% sure of that. Now, remember, it's almost 100%. It's never 100%. So this is what we're looking at. As far as the TBT, we're going to try to buy that on a pullback to either the 618 or the 786. The actual number for shorting the bonds, if you're really an active trader and you're interested in that, the number on the bonds would be at around 150. I believe it's at 150.15. So we're a full point, away from that level. So that's something that we look forward to, and I'm going to be following it on a daily basis. But the news is falling into place just like we had hoped. The open interest and volume in the in the bond market is not giving any indication that that it wants to go higher, because open interest is starting to decrease. In other words, people are getting out of the market. Okay, we're going to take a little break here right now to pay some bills for Mr. O'Brien, our fearless leader, King Dollar, and then we'll come back and we got to talk about the gold market, because the gold market is it's trying its best to get moving, but it hasn't moved yet. So 877-927-6648.
Would you like a personal update from Tom O'Brien as to what equities he's trading and what his daily trading plan is before the market opens each morning? Every market day, Tom O'Brien sends out his daily newsletter, Market Insights, to hundreds of subscribers that rely on his daily recommendations when it comes to navigating these highly volatile markets we're dealing with. As recently as May 21st, Market Insights subscribers closed out all 5 open positions for a combined profit of over 68% in one day. Profits ranged from 6.5% to over 24%, and all of these trades had been initiated within the previous 30 days. Now is the perfect time to get a 2-week free trial to Tom O'Brien's explosive trading newsletter, Market Insights, an $85 value. Tom breaks down the market each morning with his market take and provides trade recommendations, including precise stops and target profit zones, leaving nothing left to guessing. Log on to tfnn.com today and sign up for your 2-week free trial. Make sure you're a subscriber the next time Market Insights subscribers close out multiple winning trades. Take action and sign up for your free trial today. Has the current market volatility continued to stop you out of trades when temporary market spikes move against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped, and you have the advantage of keeping your trades open even when the market temporarily spikes against you. Nadex's innovation has allowed them to come up with a line of unique short-term binary options that are unavailable anywhere else. See how it works at nadex.com. That's nadex.com, or click on the Nadex banner on the front page of tfnn.com. Futures and options trading involves risk and may not be appropriate for all investors.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the Opening Call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his Opening Call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his Opening Call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the Opening Call, a $64 value, visit tfnn.com today.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to tfnn.com today. Don't miss out on this great offer. Act now.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of tfnn.com.
Okay, folks, we're back, 877-927-6648, and we had a request to take a look at natural gas, which we've looked at off and on, since way back in when it made its bottom down there at the 185 level. We had a huge move where it rallied well over $1 per cubic foot, and you'll never guess where we are right now, folks. We are trading at 224, and the 618 retracement of this market comes in at 222, and we hit that low on Friday, so we're retesting it right now. The problem is that you're going to have to assume some risk here, because if you buy it here at this 222 level, you've got to risk about $2 per cubic foot in the gas in order to see if it's going to work or not. But it's come down very orderly. It actually topped on the solar eclipse. It made a secondary top on the lunar eclipse, and now it's testing, 222. The assumption that I would do, or let me say the recommendation that I would use on this particular, because it's a commodity and it moves quite a bit, is I would give it a day or two. In other words, make sure that this level of $2.22 holds, and then let it go up a little bit and pay a little higher price for it. But at least the trend will be, starting to go higher, and then you will be able to take a look at it without risking very much. You have to risk 2 cents in it, no matter what you're doing, which is equivalent to about $1,600, I believe. and that's the that's the thing that we're worried about more about. Be concerned about how much you're risking and not how much you're making, and you'll be far better off than most people. In fact, you'll be far better off than everyone, because no one ever thinks that way. You must learn to think like a slot machine, folks. You've got to think in terms of how much money you have at risk. A slot machine, nowhere on that slot machine does it tell you that you have no chance of ever beating it, and it says on there that no matter how long you play it, you still can't beat it. And it doesn't say on that slot machine anywhere that I've taken in $1.2 million more than I've given out. So you have to, think like a slot machine and remember how much money you have to pay out in your losses. And if you take care of your losses, the profits will take care of your losses. And I know that sounds like a cliche, but it really is something that's very important. Always focus on how much money you have to risk, and you'll be a lot better off than most people. We want to take a look now at the gold market, because we are at a very critical level now for about the 15th time. Actually, it's not quite that bad, but we've hit the 61% retracement, 6 times in the last 7 months, and that's telling us that something really is really big happening. Well, since we're on the gold, we have a call from Singapore. William, are you there?
I'm here. Hi, Mr. Pesavento. Thanks for taking my call.
William, could you speak up, please? For some reason, it's coming in very faint. So if you'll speak up, okay. I'll try to hear the question one more time.
Sure. I think that's just thanks for answering my call. And basically, I would like to ask a question regarding gold and silver. It seems that it has some kind of resistance at 1,006. So I thought maybe asking for your advice. What is the situation here?
Okay. I'll try to answer it, William. Your voice was very faint coming in. I'm on a different setup than I usually am. But what I'm seeing in gold now is that we've hit the 61% retracement 6 times since September. We hit it once in September. We hit it 3 times in the December period. And we've just hit it 3 times between May and June. And I posted into the Tiger TV the gold chart, and you'll be able to see that now we have 3 higher bottoms. And the last one we made that came in around the 1560, actually 1558 level on Friday is a very important one. We really shouldn't go below that, because now we have rising bottoms.
Right.
And that means that gold has a chance to go higher, but gold really needs to get above the 1640 level to maintain its bullish appearance. Right now it still looks bullish in my opinion, and the same is true of silver. But silver needs to get above 29.50 an ounce for it to be bullish.
Okay. All right. Thank you very much, Mr. Pesavento.
Thank you very much for calling in, William. I appreciate it. I hope all is well in Singapore.
Yes, I'm fine. Thank you very much.
Okay.
Thank you.
You bet. Getting back to the gold, we really have a situation here where gold really must stay above that 1550 level. And if gold should break below 1522, that's the 61% retracement that has held up, 6 times, like I mentioned before, in the past year. And if we get below that, we're going to be looking at deflation, folks, and that would be equivalent, I think, to the crude oil going below, $82 per barrel. And if that happens, we're going to be looking at pretty much what happened in 2007 and 2008, and that's what that's what this possibility exists, and this is what we want to try to do that. Now, during 2007 and 2008, we were right on those markets during that time, and the whole premise is to keep you away from making a real serious mistake, and I think one of the most serious mistakes you can do here is to lend money to the government at 2.8% on a treasury bond. In other words, buying bonds up at this level. I know for the past several months that's been the thing to do, but these price targets have all been met now, and you've got to be extremely careful, because if this thing does turn down like we assume that it's going to be very dramatic. In catch a lot of people by surprise. If you're 2000, the bonds dropped from 149 all the way down to 112 without hardly any bounce at all, and that amount was exactly $30,000. That happened to be the trade of the year for 2009, and of course the trade of the year for 2012. The way that I wanted to, but in fact, we'll get back into this thing. But as a trade of the year, it's a loser. We're not going to, waste any time on that. But we will get back into the short side of these bonds whenever we get this bounce back that we're expecting to see. I'm going to put in the picture of what I'm looking at on the shorter term basis for the September bonds, because that's the one that we're interested in doing right now, and that level comes in at about 150.5 in the Treasury bonds. If you'll get a chance to go into Tiger TV, you'll see that the 61% retracement comes in at just 150.16. Today's high was an exact 786 retracement of the high that we made last Friday. Now, the important thing to remember here, if you'll take a look at this chart, you'll see that the market gapped down Sunday night, and it stopped right at the 786 retracement of the low made on the solar eclipse of the 20th. And that from that level, it's rallied 2 full points. That's $2,000. That's a heck of a trading rally. And where it stopped was right where it should be. Now, what the ideal situation is now that it will back and fill here a little bit and then go up one more time and, to make that target that we're looking at 150.16. I believe the equivalent on that for the TBT will be at around 1620, as I recall, and that would be the number that we would be looking at. Now, since we're talking about money and all this stuff, I think what we should do is to take a look at the dollar index. And let me stand corrected, and that's the banking index, because these are the J.P. Morgans and the what's the other name? Bank of America, type companies. And if you'll notice that when we made our bottom here on the 4th of June, it was an exact 61% retracement coming off of the November low. And now what we've done is we've had a 5-day rally that stopped at the 786 of the previous high in late May. And so this market is still in a downtrend. That's why I still think we have a chance of making a lower low sometime around June 18th or 19th, and then we will see what the next thing unfolds, as far as, we see with news. Now, the news that's coming out of Europe, I don't believe in well, that's not true. I believe in fundamentals. I just don't understand them. So what I would be looking for is to see how the market responds to the bad news. Like we had good news and the market, went way up and then came right back down again. But when the market responds well to bad news, then you know that you're pretty close, to a tradable bottom. So that's the thing that you want to try to look at. Think opposite of what the public is thinking. So if the news is really bad and the market's not going down, that's a good thing. That means the market's oversold and it's going to bounce back. But if the news is really good, and if the news is really good and the market doesn't go up, that's also telling you something. So just remember, it's how the market reacts to the news, not so much what the news is. There's so many examples of this. I mean, I remember the first one for me was in 1963 when President Kennedy was assassinated in Dallas. I was in the market at that time, and the Dow Jones dropped 30 points. Now, 30 points at that time was about 4%. That would be equivalent to about 500 Dow points, at that point. Right after, he was, had the inauguration, oh my God, terrible inauguration. But after they had the funeral, the market was, within a few days, was already way back above that point, telling you that the event really meant very little at all. And so these are the things that you try to remember, and this is why I'm a technician, because I can't understand these fundamentals. And frankly, when I listen to the people on CNBC and Bloomberg and some of the other shows, these economists like Stiglitz and Krugman and and Robini, I mean, I don't understand what they're talking about. And when Greenspan used to talk, I mean, no one could understand what he was saying. In fact, that was one of his cliches, is that if you can understand what I'm saying, please let me know. But, Bernanke's a little bit better, but, that's just my opinion, and I should get off my soapbox. Okay, now, we talked about the banking index, the fact that it's rallied a little bit, not very much. We are in a spot where I think we're going to, pull back one more time into the 18th, and that's the one that I'm watching, the closest. Now, the chart that I think that I follow the closest as far as what the stock market is doing is the New York Stock Exchange Daily Index, because that's the one that really is the broadest and fairest of all of the things that we're looking at. And if you get a chance to go into Tiger TV, you'll see that we missed the exact 61% retracement on June 4th by about 20 points on a 7,000 handle. So that was less than, half of 1%. And we've had a pretty good rally. We rallied 5 days now, but we still did not take out the high of the previous week in late May. We did that in the futures market overnight, but not in any of the other indices. And I think that's another indication why, if you're trading these indices, if you'll take a look at the euro, because the euro is real money and it's real people making real bets, whereas in the S&P, it's just a very, very small market. I mean, it's probably 5% of what the euro market is. And, that's where the real money is. So watch to see where the players are, and you'll get a better idea of, if these moves are really going to be, substantial. Because if this was really good, the euro would have, continued to go up, another 150 or 200 pips. And, the Dow would probably up another 200 or 300 points today. But in fact, it didn't do that because it, didn't react to the good news, very much. And this was what I was trying to, bring about when we were talking about this, during this last dissertation of mine. And, we'll probably hear more about that, because I like to see how the news reacts to these things, and because I just look at the bar chart. If there's more buying, people, the bar chart will go up. If there's more selling, the bar chart, will go down. That's the bottom line. Someone asked another question about the natural gas, the fact that it's trading down here, at the 61% retracement, and why would I wait? Well, the only reason that I'm waiting is the fact that, it's down here, and I would prefer, to have the market turn up a little bit to make sure that the 61% retracement is going to hold, and then buy the first little pullback. Well, if you do that, you always run the risk that maybe it's not going to pull back. But frankly, these markets are active enough that they usually give you, one or two really good chances. A perfect example of that is gold. We talked about that after the market bottomed. We said it'll give you several chances to buy it. And in the last 7 trading days, gold is backed off to the 786 retracement of the bottom from June 4th 4 times. So you could have done it very easily. Okay, we've got to take a little break here. 877-927-6648. And when we get back, I want to talk a little bit more about the British pound.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now. With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you gain access to each host charts and computer screen as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, Kate Stalter, Dave White, Larry Pesavento, or Victor Jones, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV yet, then visit TFNN.com today to see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
It's that time of year again, and the Great Panther Silver Summer Silver Giveaway is back. Every day in June, Monday through Friday, we'll be giving away a Great Panther Silver 1-ounce silver bar, and all you have to do to enter is visit the front page of TFNN.com and fill out your entry. Great Panther Silver and TFNN wishing you a great start to the summer. Sign up today to have a chance to win a 1-ounce silver bar during the Great Panther Silver Summer Silver Giveaway the whole month of June at TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back wrapping the show up, folks. I put the chart in for the British pound to show that the three major bottoms we've had over the last 7 months have come in around this 152 level. And, if we go below that, that's going to be very, very bad for the UK. It'll make the U.S. dollar, much, much stronger, and that's pretty much what we're looking for. I also wanted to post one more of the currency charts that we've, really strong interest in because we've been following Steve Rhodes' recommendation on this. It had a beautiful pattern in the dollar versus the Japanese yen down at the exact 177.60 level. It stopped there, and it's rallied well over $4,000, a contract. So hats off to our friend, Steve Rhodes, for alerting us to that one. The other request that I had, we've only got a few minutes left, but I wanted to put up the natural gas, and we'll look at it just like we would on a daily. But what we'll do is we'll go down to a 30-minute chart, and you can see here that we are. The 222 level that we were talking about before, it's still in a pretty major downtrend here, and so my assumption is that we should wait until we get a little bit more of a tradable bottom from this level, and that's what we would be looking at. It's setting exactly at the 61% retracement now at 222.60, so if you buy it here, you frankly you don't have to risk very much at all. Now, I didn't have a chance to post the natural gas on what it was. I put the natural gas chart up. It's listed under NG, pound F. And pound F in the Ensign program just means that's pound F means nearest futures month. That's the one that's the most actively traded, and they roll it over, automatically, for you, and that's what you're looking at. But we're right at the level, where I think it's best to wait. That's my opinion. But if you do buy natural gas in here, you've got to risk about 2 cents. My 2 cents worth is wait. Wait for the bottom to be made. We've hit this level 1, 2, 3 times, and we're trading just at it right now. And if it was really good, it would have exploded out of here several days ago, and it didn't do that. So what you want to do is to wait and get a better entry point, because it could come all the way down to the 786, which is $2.08 per cubic foot. That would even make it even a better place to buy it. But if you do buy it here, you don't have to risk more than 2 cents. But my suggestion is wait for a bottom to be formed, and then when it rallies up a little bit, you would be able to buy it back on a little retracement of the 61% retracement, and still risk 2 cents, but you'll know that the support has actually held. That was a strategy that we were looking at in gold, and it worked 4 times. I mean, every time it hit it, it would make a higher bottom, and that's all you're doing is you're looking at the probability of not risking a great deal of money. Like Mark Douglas says, this is not a business of being right or wrong. It's a business of making money. And that's what you're trying to do, is to, think like that slot machine. Think like the winner. A winner thinks, how much money can I lose? A loser thinks, how much money can I win? That's why Las Vegas does such, really good business, and so does the lottery. What is the lottery? There's 180 million, 300 million, whatever it is. They're just telling you how much you can make, but they don't tell you that the odds of winning, are 1 in 390 trillion or whatever it happens to be. So remember, with every risk, comes an opportunity, and you just want to put the opportunities on your side. So that's it, folks. Everybody have a wonderful day, and may God bless.